Welcome back to the Deep Dive. Today we are digging into the infrastructure of the whole AI explosion. We're skipping the usual suspects, the chip makers and software giants. We are focusing on a company called Ciena. That's ticker CIEN.
Yeah, and they're what you might call a foundational layer, the essential plumbing, really, that underpins all this data growth.
Exactly. So your mission for this deep dive is to figure out what's behind all this massive analyst excitement we've been seeing. We need to look at the actual earnings that started this firestorm and then ask the big question. Is there still an opportunity here, or has the ship already sailed?
Has the market already priced it all in?
Right. Okay, let's unpack this.
Yeah.
Specifically, how did a company that makes optical networking gear become one of the hottest stocks of late 2025?
It really is the classic pick and shovel play on this modern gold rush.
I like that analogy.
Yeah, I mean, Ciena isn't making the AI models themselves. They're not writing poetry or generating images. What they do is supply the hardware.
The really specialized stuff.
It's extremely specialized. We're talking about optical transport, coherent optics, the gear that lets data move at incredible speeds between these massive data centers. And this is key, within the data centers, too.
Okay, so break that down. Why is that internal connectivity so important?
Well, think about what AI needs. It's just immense computational power, right? Thousands of GPUs all linked together. If you have all that horsepower, you need the connections between them to be just lightning fast, ultra reliable. That's where Ciena lives. They provide the pipes, the pumps, whatever you want to call it.
So the investors love them because they're indispensable.
Exactly. It's structural exposure to AI without having to bet on which specific application is going to win. It's a much safer hardware-level bet.
And the market certainly seems to agree with that thesis. I mean, our sources all pointed to December 2025, right after Ciena released its Q4 results.
Oh, the reaction was immediate.
The stock just took off. It climbed nearly 15% right after the release.
15%. That's a huge move for a company this size.
So let's get into the numbers. What did they actually report? The top line revenue was $1.35 billion for the quarter.
Which, on its own, is a really solid number. But the context is everything.
Right. It's a 20% increase compared to the same time in 2024. That's healthy structural growth.
It is, but that wasn't even the headline grabber.
No, the real story was further down the income statement, the non-GAAP net income. It just surged.
An extraordinary clip, yeah. It hit nearly $133 million.
Which is a profit surge of 68%.
68.
And that's the ratio you have to look at. A 20% revenue gain leads to a 68% profit surge. That tells you something important is happening.
It really does.
And what's fascinating here is just how thoroughly they beat what everyone was expecting.
The consensus estimates.
Yeah. I mean, it's one thing to grow, but they completely outperformed. Analysts were looking for, what, about $1.29 billion in revenue?
And about 77 cents per share in profit. Right. And Ciena didn't just meet those targets. They sailed right past them.
So why?
Yeah.
How does that happen? A 20% revenue jump is about selling more stuff, but a 68% profit jump, that's something else.
That's about pricing power. It's about product mix. You see, Ciena's best tech, their flagship stuff like the WaveLogic coherent optics, it's highly differentiated.
So it's not a commodity.
Not at all. When demand for these high-speed links between GPU clusters just explodes, Ciena doesn't have to discount its best gear. They're selling mission-critical, high-margin components.
Okay, that makes sense. So they're not just selling more, they're selling more of their most profitable, most important stuff.
Precisely. And the CEO's commentary really backed this up. Gary Smith came out and said the performance reinforces our position as the global leader in high-speed connectivity with an expanding role in the AI ecosystem.
You always have to take CEO statements with a grain of salt, though.
You do. You absolutely do. But in this case, the numbers, that margin expansion, it really does prove they're expanding their role in the most valuable parts of that whole AI data pipeline.
All right, so that was a fantastic quarter. That's the past. But for anyone listening, the real question is the future. How did they project this boom into fiscal 2026?
Well, they didn't waste any time. They immediately signaled that they expect the good times to keep rolling.
They gave strong guidance for Q1 and for the full year. And the headline number that really got the market's attention was that full-year revenue range.
Between $5.7 billion and $6.1 billion.
So let's connect that to the bigger picture. Why was that guidance so powerful?
Well, you have to look at the low end of that range, that $5.7 billion figure. That alone is a projected 19% higher than their 2025 result.
Wow. For a company of their size, projecting another year of nearly 20% growth that's a big deal.
It's a huge deal. It suggests these AI tailwinds are not a one-time thing. They're structural and they're long-lasting.
And it was also higher than what analysts were expecting, right?
Comfortably higher. The average estimate was sitting just over $5.5 billion. So when management guides this aggressively above consensus,
it signals they have visibility, they have contracts.
Exactly. It signals they've locked in deals for AI connectivity that the market hasn't even fully priced in yet.
And they also gave some guidance on profitability, targeting an adjusted operating margin between 16 and 18%.
Yeah.
Why is that number so important in the hardware world?
That margin forecast is the financial proof of their pricing power. In hardware, margins can get squeezed so fast, especially with supply chain issues or, a shaky economy.
Right.
So for them to project margins in the high teens, close to 20%, it tells you they are not competing on price. They are competing on technology that is essential and maybe even a little scarce.
So it confirms they're managing their costs well while still ramping up for this massive build-out.
It sounds like management is not only seeing the demand, but is executing on it almost perfectly.
Okay, here's where it gets really interesting. You have strong numbers, you have strong guidance. And that's the recipe for an analyst frenzy.
And that is exactly what happened.
In the weeks after that Q4 release, you had multiple analysts upping their price targets, some of them, dramatically.
What everyone was talking about, yeah.
The one from our sources, from Raymond James, the analyst, Simon Leopold, his revision was it was profound.
It really was.
He more than doubled his fair value estimate for Ciena. He raised it from $120 a share all the way up to $250.
$120 to $250. I mean, that kind of jump. It's like watching a stock skip 3 grades overnight.
You just don't see that.
You rarely see that level of conviction, 108% price target increase, unless the analyst believes the market is fundamentally misunderstanding the company's long-term potential.
So what was his reasoning?
It wasn't just about the volume of orders. His optimism was really fueled by how effective management has been at broadening their customer base beyond just the traditional telecom companies.
And into the hyperscalers.
Yeah.
The data center giants.
The ones driving AI, exactly. The view, Hilua, was that this growth we're seeing now, it's just the beginning.
Just the beginning. That's a strong statement.
It suggests Ciena is positioning itself to capture an even bigger piece of this multi-year build-out.
And when you look at the financials, you can see why he's so bullish. As of January 12th, 2026, the market cap is around $32 billion. And their gross margin is 39.31%. Let's talk about that gross margin again. Why is a number near 40% such a powerful signal in this industry?
It is absolutely critical. For a company that makes complex physical hardware, fiber optic gear, advanced silicon, a gross margin near 40% is seriously impressive.
It tells you they have a moat.
A huge one. It tells you they're making proprietary equipment that competitors can't easily replicate. Customers have to pay a premium for Ciena's performance. If this were a commodity product, that margin would be, closer to 20, maybe 25%.
So that high margin is the proof.
Yeah.
It gives analysts the confidence that all this future revenue growth is going to translate very efficiently into massive profit growth.
That's the bull case in a nutshell.
So, if the numbers are phenomenal, the guidance is aggressive, and analysts are doubling price targets, you might be asking yourself, where do I sign up?
Right.
And this brings us to the most important part of our deep dive, the critical assessment, moving beyond the hype.
The reality check.
Yes. So what does this all mean for someone like you who's trying to figure out where to place a bet on the AI trade? While the fundamental story is, well, it's airtight, our sources raised a pretty distinct caution flag.
A big one. And it really centers on 2 main points about where Ciena is right now.
Okay, what are they?
First, Ciena is, and I'm quoting here, hardly an undiscovered stock. It's a well-known name. It's been on the radar for a while now.
Not some hidden gem.
Not at all. And second, and this is the really key part for new money, it's considered expensive on both a price and valuation basis.
Let's break that down. Price and valuation basis. When an analyst says a stock is expensive on a valuation basis, what are they looking at? Is it the PE ratio?
It's almost certainly the forward PE, yeah. And probably the PEG ratio, too, the price to earnings divided by growth.
Okay.
When a stock like Ciena has such a massive run-up, its PE ratio stretches way beyond its historical average. It means investors are paying a huge premium for every dollar of future earnings.
So the market isn't just pricing in that 19% growth for 2026.
It's pricing in perfection for years to come. And if Ciena misses just one quarter, or if the pace of the AI build-out slows down even a little, that premium could just, poof, evaporate.
So what's the implication then for someone looking to invest today?
The implication is significant. The source suggested that investors looking for that next big high-growth AI opportunity might be better off looking for a more under-the-radar AI-related title.
In other words, the easy money has already been made.
The money you make from discovery, from finding something the market missed, yes, that part of the journey seems to be over.
And you can really see that when you look at the stock chart. The 52-week range in the source material goes from a low of about $49 all the way up to $261.
49 to 261, I mean, that incredible range just shows you how much of this AI narrative has already been baked into the price. It makes that caution flag totally warranted.
Okay, so let's try to summarize this whole deep dive. We established Ciena's essential role, the pick-and-shovel supplier for AI data clusters.
Right, the coherent optics that are so vital for linking everything together.
Their Q4 2025 results were exceptional. A 20% revenue jump, a stunning 68% profit surge. They blew past all the estimates.
And that proved their pricing power, which led directly to that aggressive future guidance for 2026.
Which in turn led to analyst euphoria. We saw Raymond James' Simon Leopold doubling his price target to $250, showing just immense confidence in Ciena's position. But the critical assessment is that the stock is now expensive. It's been discovered, and it seems to be priced for absolute perfection.
Which really raises an important question for you as you think about all this. If Ciena, the crucial supplier of this high-speed data plumbing, is already trading at a huge premium and is considered discovered, what does that imply about the other opportunities out there?
The other, less obvious layers of the infrastructure.
Exactly. The other layers that are still absolutely required. Think about the specialized cooling systems you need to keep thousands of GPUs from melting.
Or the advanced power generation.
Yeah.
These data centers are incredibly energy hungry.
Power generation, power distribution, or even the raw materials, the specialized fiber, the rare earth elements. The demand for AI infrastructure goes so much deeper than just connectivity, and maybe that's where the hunt for the next under-the-radar opportunity really begins.